Hello and welcome to Capital Market in the Security Analysis for Ethiopia. This is video 3. Today we are going to see a function of financial markets. In the previous we have seen the definition of financial markets, and also we have seen the classification of financial markets. Under classification of financial markets, we can categorize financial market depending on their criteria. The first criteria that we have seen is nature of claim. Depending on the nature of claim, we can categorize financial markets into debt markets and equity markets. Depending on the issuance or freshness of the claim, we can categorize financial market into primary and the secondary markets. And also based on maturity of the claim, we can categorize financial market into money markets in the capital market, or short-term maturity and the long-term maturity. Depending on the structure of the markets, we can categorize financial market into exchange traded markets and over-the-counter or OTC market. In another ways, centralized location and disorganized location financial markets. Today, we are going to see a role of financial market or function of financial market. I am Balai Zaude. The function of financial markets, the role of financial market in success in the strength of an economy cannot be miscalculated or undermined. Here are 4 important functions of financial markets. The first function of financial market is determination of the price. The demand and the supply of an asset in financial market help determine its price. The interaction between the two participants, supplier and the user of funds, and the other market force help determine the price. So the function of financial market in the first is to determine the price of the financial instruments. The second one is function of financial market is borrowing and the lending. For an economy to be successful, it is vital that the money does not sit idle. So a financial market helps in connecting those with money with those who require money. The third function of financial market is liquidity and the risk sharing. The buyer and the seller can use financial market to sell their securities or make investment as they desire or as they like. Liquidity is an important reason for investors to participate in trade. The fourth is information efficiency. It saves time and the money as it is, where buyer and the seller can easily find each other without making too much effort or wasting their time. So it is very important for information and the efficiency of the information. With this, we come to the end of function of financial markets. Now, let us see financial instruments, its definition, other issues. Definition of financial instruments. Financial instruments are also known as financial asset, or we call it financial security. But security is general name for financial instruments. They are the products such as money, stock, bonds, derivatives. It is traded in financial market. They are contracts for monetary assets that can be created, modified, traded, or settled for. The characteristics of financial instruments. Financial instruments possess the following basic characteristics. The first one is moneyness. It has the character of money. Some financial assets like money act as medium of exchange or its settlement of transaction. This moneyless characteristic of financial instrument is when there is a secondary market. Otherwise, it is not call it as moneyless, because if there is no secondary market, we cannot exchange or we cannot sell our securities in the gates money. So it needs a secondary market. There is other financial assets, also not money, but can easily be transferred into money at little cost, delay, or risk. It has no risk, or has little risk, or a little delays. If you have one security, whether it is treasury bonds or whether it is bills, treasury bills, or debt securities or equity securities, you can change into cash with a short period of time. This is if there is secondary market, you can sell in the gate money or you can use as transaction. The other characteristics of financial instruments are divisibilities in the denomination. Divisibility relates to minimum size at which financial asset can be liquidated and exchanged for money. The smaller the size, the more the financial asset is divisible. What is divisibility means? How can we define divisibilities, or how can we categorize under character of financial instruments? Let us take example. Shares, highly divisible. Real estate, low divisible. Why? Let us see the example. You can buy one share, or you can buy 10 shares or 5 shares, or you can buy 100 shares, even fraction of shares on some platforms. But in low divisibility, such as real estate, you cannot easily buy or sell 25% of the house. It is not easily divisible. You cannot purchase half house or uh, or 90% house or 20% house like share. That's why we can categorize financial instrument character as divisibilities. Very divisible, highly divisible, in opposite of low divisible like real estate and the like. There are other characteristics of financial instruments are reversibilities or round trip costs. What is reversibilities or what is round trip cost? Let us see. They refer to the cost of investing in financial assets and then getting out of it and back into cash again. Total cost of buying and selling a financial asset, including all fees or commissions. This means, for example, when you purchase security, you will pay fees, service fees or commission. And also when you sell your security, you can pay fees or commission or service fees. Those both together is called as round trip costs. This is the character of financial instruments, that is reversibility or round trip costs. I think it is clear. The other characteristics of the financial instrument is bid-ask spread consists of a difference between price at which market maker is willing to sell a financial asset, that means ask price for a seller, and the price at which market maker is willing to buy a financial asset, that is bid price. The difference is known as bid-ask spread or the spread. The other characteristics of financial instrument is term to maturity. Term to maturity. Term to maturity is the length of interval until the date when the instrument is scheduled to make its financial payment or due date, or the owner is entitled to demand liquidation. Debt usually set specified maturity, but equity set no maturity, and are so for perpetual instruments, as we have discussed under types of financial markets. There is a debt securities and the equity security based on its maturities, based on the maturity as criteria. So, for example, in Ethiopia, the treasury bill maturity date it has 4 maturity dates. The first one is 28 days maturity, 91 days maturity, 182 days maturity, and 365 days maturities. So the length between the time of agreement and the time of getting payments, that is interest, as well as principal, is known as terms to maturity, or the interval in between. For debt that is specified or is fixed time of maturities, for equity, as we said, it is unlimited time of maturity. This is another character of financial instrument. The other character of financial instrument is liquidity. Liquidity is the degree to which financial security can be quickly purchased or sold in the market at price reflecting its current values. This is liquidities. Liquidity refers to a simplicity with which a financial securities or asset can be converted into cash at market price, or easily converting into cash. The other characteristics of financial instrument is convertibility. Financial instruments can be converted. We can convert our financial instrument from one to another, or for example, from debt to equity security, or from equity security to debts and the like. It is an important property of some financial assets converted into other financial assets. Conversion may take place within one class of financial asset, as when bond is converted into another bond, or another class of financial assets such as bondholder can change it into shareholder. This is another characteristics of financial instruments. The other characteristics of financial instrument is currency. Most financial assets are denominated in one currency, such as USA dollars, or yen, or euros, or others, and the investors must choose them with that feature in mind. Some issuers issues dual currency securities with certain cash flows paid in one currency and the other cash flows in another currencies. The other characteristics of financial instrument is cash flow and the return predictabilities. The predictability of expected return depend on the predictability of cash flows. The return that an investor will realize from financial asset depend on cash flow expected to be received, such as dividend payments on equity security or on shares or on stock, and interest payment on debt instruments, that is debt securities, and the principal repayment for debt instruments and expected sale price of a share or stock. This is another characteristics of financial instruments. The final one is character of financial instrument is tax status. Tax rate from the income from the ownership or sale of financial assets differ in country to country, financial asset to financial assets, depending on the types of share, the length of a time the asset is held, the nature of the owner, and so on, year to year. For example, in Ethiopia, treasury bill has no tax. That means interest income that you can get from treasury bill, there is no tax. It is tax free. So you can invest on treasury bill or government treasury bill because you can get the benefit of tax. You will not pay any tax on the income of the interest you can get from treasury bill. Like, for example, if you purchase treasury bill of 28 maturity and if you get 1 million or 2 million, you can get totally 2 million. There is no tax, so you have to invest. With this, I come to the end of the today's program, and I thank you for your views. Please, if you like or liked, subscribe to my YouTube and share. My YouTube is at Balaizode 1986. Thank you very much.